Okay, good afternoon, everyone. Thank you for joining us today. My name is Maria, and I will be hosting today's webinar. So let me start by introducing our special guest and speaker, Erik Norland. So Erik is the Executive Director and Senior Economist of CME Group. He is responsible for generating economic analysis on global financial markets by identifying emerging trends, evaluating economic factors, and forecasting the impact on those who trade in its various markets. He is one of the CME Group spokespeople on global economic, financial, and geopolitical conditions. Prior to joining CME Group, Erik gained more than 15 years of experience in the financial services industry, working for investment banks and hedge funds, both in US and France. He holds a bachelor's in economics and political science from St. Mary's College of Maryland and master's in statistics from Columbia University. He is also a CFA Charterholder. So I guess we can start our webinar now. If anyone has questions during the session, please feel free to post them in our chat box. We will have Q&A round with our speaker at the end. So Erik, stage is yours. We can kick off our commodities webinar.
All right, great. Well, thank you so much. And Happy New Year to everybody. I hope that 2023 has been good so far and that the rest of the year will turn out very, very well for you. Before we begin, I do have to show you both the short version as well as longer, more detailed version of CME Group's disclaimer, which basically says that because CME Group is an exchange operator and not a broker-dealer or an investment bank, we cannot make any sort of investment recommendations. But with that in mind, let's begin talking about what I think is going to be the single biggest story for commodities in 2023, and that's going to be the reopening of China. But this is a very, very complicated story. It really is not as simple as you might think. The sort of simple version of it is that China's reopening should be great for commodity markets and everything should come back right away. And that could be true over the long term, but in the short term, China's reopening, of course, poses a lot of challenges for China. So on the one hand, there are basically, as I understand it, very few, if any, COVID restrictions left in China at the moment. But we have had a tremendous number of COVID cases there in the last month. The government there is being very cagey about exactly how many COVID cases there have been. So there's a sort of lack of transparency. But it seems as though when you add up the COVID cases being reported in individual cities across China, that very plausibly there were maybe 100 million cases or maybe 200 million over the last month. As it spreads through a population, it has very little natural immunity and perhaps has vaccines that are not particularly effective. The Chinese government has also not really been reporting the number of people dying as a result of COVID either. But there has, however, been a lot of information collected in the private sector. So, for example, China has like a National Academy of Film and a National Academy of Sciences. And when very prominent, famous people in China die, their obituaries are reported in the newspaper. And so if you look at the number of obituaries of famous people that are being published, it's running at about roughly 15 times higher than normal over the course of the last month. So it's an indication that China is, in the midst of a very, very intense wave of COVID that could become more intense later this month and early next month as they celebrate Chinese New Year, which of course is a very fun celebration, but also is sort of almost the definition of a super spreader event. So it's very plausible that over the next couple of months, they're going to have huge wave of COVID, and this could actually, in the short term, depress economic activity. It could make people more reluctant to go to work, to go to restaurants, to go to films, and especially, of course, to travel. However, it seems likely that as we move into the spring and summer, once we get into April, May, June, and the summer months, that this wave of COVID will have faded, and you will see a massive rebound in travel from China, which could really, really boost demand for oil globally. China has been almost impossible to travel into or out of China in the last 3 years. So compared to 2019, in 2020, 2021, and 2022, air travel in and out of China was down by about 98%. So China's market for air travel previously was about 1/7 of the world total. So about 14% of the world total, of which about half was international in terms of fuel demand. So it's very plausible that China's reopening could boost global demand for jet fuel by maybe about 7% or so, which is pretty significant because jet fuel is about 10% of the use of crude oil. So that would boost demand for crude oil by nearly 1%, which I know probably doesn't sound like a lot, but a 1% increase in demand for crude oil in a sort of normal world could boost prices by perhaps as much as 10%. So in China, there's, of course, multiple measures of economic growth. One is the official GDP, which you see here in black. The one I prefer is called the Li Ka-shing Index. It's a much more volatile measure. But recently it's been showing China's economy growing at around 4.9% year on year, which is pretty slow by Chinese standards. We may see a continued dip when we get the December number, which should be reported soon, and also the January and February numbers, which will get out in February and March respectively. The Li Ka-shing Index is something that's very hard for the government to manipulate. It includes bank loans, electrical production, and rail freight volumes. But what's interesting about it is that when you correlate the Li Ka-shing Index, which you see here in the light blue, with crude oil, or West Texas Intermediate crude oil, which you see in the dark black, you see that there's actually a pretty high correlation, but that correlation tends to happen with a significant lag. So the strongest correlation is between 3 and 4 quarters in the future. So at the moment, China's economy is growing very slowly. It looks like they're in for maybe 3 more bad months before things really rebound. This could be quite depressing for crude oil prices in the year 2023. However, as China hopefully begins to stage a large rebound over the course of the summer months, maybe the spring months as well, that could increase demand for fuel, and that could ultimately wind up with much, much higher petrol prices around the world. Maybe a 0.7% increase in demand coming from jet fuel globally, but some additional increases in demand as China travels more domestically and as they drive more. As offices reopen, factories, come back to full levels of production, et cetera. Now, I think what's interesting about the oil market, and I think maybe the most basic question you can ask about any market, is what is already reflected in the price. So in this left-hand chart, you can see that the forward curves for oil are in backwardation, which means that the near-term price for contracts expiring this month in January and February, March, April, May are significantly higher than they are further out in the curve for contracts expiring, say, at the end of this year or the end of next year. So the market is expecting a decline in prices. I think in some ways maybe the market has us a little bit backwards. The market actually thinks that maybe oil prices will increase very slightly over the next few months. That might not be the case if China's demand remains depressed for another few months. And then the oil market seems to think that oil prices will then subsequently decline, which could happen, of course. There's a lot of different factors. It could be that OPEC boosts production, or that Russian oil floods the market at extremely cheap prices because of the various sanctions and oil price caps that have been put on Russian oil. It could be that U.S. production rebounds further. But it looks to me kind of in general, like with Chinese demand, that we may have a risk of higher prices. So when you look further out on the curve, like the December 2023, the December 2024 contracts, those may have significant upside risk if China's economy rebounds. There's another reason, I think, to be somewhat bullish on oil as well, and that's on the right-hand chart. When you look at the level of inventories across crude and products. Inventories at the end of 2022 were relatively low, and we actually get the first 2023 inventory number actually comes out later this afternoon when the Department of Energy releases that data. I think around 3 p.m. London time, so maybe around I don't know, I suppose that'd be around 6 p.m. or so if you're in Dubai. And so, the inventories are relatively low. That means that the oil market could be very sensitive to any increases in demand coming from China or other parts of the world. But of course, there are other reasons maybe why the oil market is correct to be in backwardation. As we'll talk about later, the U.S. Federal Reserve has boosted interest rates by more in the last year than they have in any 12-month period since 1981. So the Federal Reserve has done this very dramatic tightening of interest rates. We also see much higher rates here in the United Kingdom. The European Central Bank has been raising interest rates. Japan has ended its yield curve control policy. And many central banks in emerging market countries, from Brazil to Mexico, have raised rates very significantly, as have other smaller Western countries like Canada or Sweden or Switzerland. So all of this could translate into much slower economic growth, which could be bad for oil demand globally and could also be bad for China's exports. So, even if China's economy starts to rebound internally, the external picture for China is maybe not so positive. Agricultural goods also have their own forward curve as well. The forward curves for agricultural goods in some ways resemble that of oil. If you look at soybeans and corn, for example, the soybean and corn markets also are priced for relatively stable or perhaps slightly higher prices in the very near term, but then followed by significant backwardation as you get into the second half of 2023 and into 2024. So the markets think that as oil prices come down, that is likely to depress prices of corn and soybeans. The one exception to all of this is wheat. Wheat, of course, is an exception as a result of the conflict between Russia and Ukraine. Russia and Ukraine are not significant exporters of soybeans. Their influence on the soybean market is very indirect. It comes through sunflower oil. Sunflower oil is mainly produced in Russia and Ukraine. That market's been very severely disrupted, and as a result, there has been some increased demand for soybean oil and palm oil and other vegetable oils. But in general, though, they're not big producers of it. Russia and Ukraine do produce corn, but their corn exports are relatively small compared to those of the U.S. And Brazil. However, for wheat, Russia and Ukraine are the primary exporters. They export between the two of them the equivalent of about 7% of global production, which is much, much higher than any other country. The U.S., for example, exports about 3% of global production of wheat. In Australia, anywhere from 0 to 1%, depending on how strong of a harvest they've had. So unfortunately for the moment, the market's viewpoint seems to be that there is no end in sight for the conflict between Russia and Ukraine. So far as we're able to tell, the Ukrainians are very determined to continue fighting for their country and to restore the borders to the way they were before 2014. Western countries continue to supply them a lot of arms and other funding that allows them to fight this conflict. And for his part, Vladimir Putin also seems very unwilling to back down. So nothing is really changing on that front, unfortunately, as much as we might like to see an end to that conflict. And the market's view is that this is going to remain very, very severely disrupted for at least the next 2 years, maybe even the next 3 years. And so that is, rightly or wrongly, how the market prices this. Now, if it turns out that the conflict ends more quickly, then wheat prices could have a lot of potential downside. They could wind up correcting downwards towards the levels that are expected for corn and soybeans. When it comes to agricultural goods also tend to follow what's happening in China. And so China, of course, there are basically, I think, three influences that we're going to talk about. So we've already talked about COVID. Another one is the condition of China's domestic property market. And the third one, of course, is China's external environment, which basically means the ability of the rest of the world to buy Chinese exported goods. And when it comes to corn, for example, corn prices tend to follow what's happening with the Li Ka-Cheng index with the lag of anywhere from 4 to 7 quarters. So if China goes through a slow patch of growth over the next few months, that could potentially depress corn prices very, very far into the future, maybe even 1 to 1.5 years into the future. Likewise, if China does have the rebound in the second half of the year, or even starting in the second quarter that I expect, that might not help corn prices very much in the near term. It might not impact corn prices much this year, but it could be very positive for them in 2024. It's a very similar story for wheat. Wheat prices also tend to follow what's happening in the Chinese economy, but with a lag again of about 4 to 6 quarters, so about 1 to 1.5 years. Again, so if China's economy is very slow today, that could mean further downward pressure on wheat prices in the short term, but not necessarily in the long term if China winds up rebounding strongly. Soybean oil also has a very strong connection to Chinese economic growth. And that connection is a little bit quicker than it is for corn and wheat. It looks like it's about 4 quarters on average, rather than 4 to 6 quarters like it is for the other ones, although the impact of Chinese growth can spread out over a long period of time. As I mentioned, soybean oil prices at the moment are extremely high as a result of the disruption to the supply of sunflower oil. So to some extent, these two vegetable oils are substitutable for one another. And as a result of the interrupted supply for sunflower oil, soybean oil prices have been extremely high in recent months. They have come down off their recent highs. And Chinese growth is very slow, so that would probably, if anything, probably bias those prices a little bit on the downside going forward. There's also, I think, the question is, to my mind, is why is it that Chinese growth influences the price of agricultural goods? And the answer is not immediately intuitive. If China's economy grows a little bit faster or a little bit slower, I actually don't think it has much demand on Chinese demand for corn or wheat. Rather, I think what's happening is that it influences China's demand for crude oil. And as you can see in these two charts, corn and wheat prices are very, very closely connected to the crude oil market. And I think that there are basically two reasons for this. First reason is that farming is a very energy-intensive business. So oil is a very significant portion of the cost of farmers around the world. And the reason for that is farmers have to plow their fields, they have to plant their crops. That all requires crude oil-powered machinery. The same is true for harvesting the crops, and then the crops have to be shipped to storage facilities or shipped to markets afterwards, and that also requires crude oil. Crude oil also enters at other stages. For example, pesticides are produced in part from crude oil or largely from crude oil or byproducts of crude oil. So what happens to crude oil prices determines a lot of the production costs for agricultural goods. Basically, for a meal that you eat today, for every 1 calorie of food that you consume, there were 10 energetic calories of crude oil that went into, or crude oil products that went into making that food possible. For corn and wheat, it's a little bit lower. It's maybe 4 or 5 calories of petrol energy per calorie of corn or wheat. And of course, it's much, much higher for meats. But, corn and wheat can also be used as animal feed as well. So, and indirectly, it still influences the price of food. There's also, I think, a very interesting and counterintuitive connection between vegetable oils and crude oil. I spend a lot of time talking to farmers around the world. And so, one of the questions I hear from them very often is, what impact on vegetable oil should we expect from crude oil? And when I looked at this problem very closely a few years ago, it seems to me like it's actually better to ask the question the other way around, which is what is it that vegetable oils are telling us about the crude oil market? If you look at these charts very, very closely, what you can see is a strange pattern where vegetable oil prices often peak before crude oil and hit bottom before crude oil. So if you look, for example, in 2007, soybean oil and palm oil prices were very, very low, but they started increasing at a time when crude oil prices were falling at the end of 2006 and early 2007. And they had this huge bull market in vegetable oils that anticipated a later bull market in crude oil that took place through 2007 and into the middle of 2008. But palm oil and soybean oil prices peaked in January 2008, which was about 6 months before crude oil prices peaked in July 2008. Vegetable oil prices then began crashing in a way that anticipated the crash in crude oil prices. Vegetable oil prices hit bottom in December 2008. Crude oil prices hit bottom in February 2009, so about 2 months later. Vegetable oil prices, you can see in 2011, peaked a little bit before crude oil did. And they began this long slide, which anticipated this crash in crude oil that we saw at the end of 2014 and in early 2015. Vegetable oil prices hit bottom in October 2015, which was 4 months before crude oil hit bottom in February 2016. Since then, you've seen little peaks in vegetable oils and little valleys, often before crude oil. So that was true during the pandemic. Vegetable oil prices hit bottom before crude oil. They peaked out most recently in May this year, in early May, which is about a month and a half before the peak in crude oil prices. So I would look at palm oil and soybean oil as possible leading indicators of crude oil. So the question is why. Some of it also comes back to the issue of biofuels. Of course, biofuels is what I meant to mention also when we're looking at corn and wheat prices. This is the other reason why corn and wheat prices tend to track crude oil, is that they can also be used for biofuels, especially corn, which one of its major uses is ethanol. So palm oil is often used as a bioadditive in Malaysia and in Indonesia. And soybean oil can also be used as an additive for fuels as well. And of course, both of them compete with other vegetable oils that can be blended into final fuel blends as well, that are substitutable, like sunflower oil, for example. So I think that there's still this very, very tight connection between what happens in crude oil and what happens in agricultural goods prices. That should be something that people pay very, very close attention to. But I think the other reason why palm oil and soybean oil track crude oil, or to maybe anticipate crude oil, is the relative size of the markets. Soybean oil and palm oil are very large markets, but they're very small compared to crude oil, which I think makes them hypersensitive to changes in demand for crude oil. So, for example, if the refiners of crude oil start to sense that there's going to be a shortage of crude oil, they can call up the farmers and say, hey, could we have more soybean oil? Could we have more palm oil or more sunflower oil or more ethanol from corn or sugar to mix into our final fuel blends? And because those markets are relatively small, you can have outsized price moves in anticipation of a later price move in crude oil. Likewise, if there's going to be too much crude oil, the refiners can tell the soybean oil and palm oil producers, hey, we don't need any more. And you might see a crash or correction in soybean oil and palm oil prices before you see a crash or correction in crude oil prices. The next thing I think we need to talk about is still talking about China, but talking about a different aspect of China. So we've talked about China's reopening from COVID. It's going to be, again, very difficult in the near term, but hopefully will lead to much higher economic growth in the long term for China. But the COVID reopening is, of course, not the only thing that's happening in China. So over the last decade and a half, since 2009, China has seen this explosive growth in debt. China, in many ways, rescued the global economy after 2008. The Federal Reserve and the U.S. government and the ECB had a lot of trouble stimulating growth in their economies after 2008. So they had a very slow recovery in the U.S. and in Europe and in Japan. But China went into 2008 with very, very low levels of debt. In 2008, China's debt level was 140% of GDP. So coming out of 2008, China was able to do this massive level of infrastructure investment. It created a huge boom in demand for commodities. Now, we saw that through the Li Ka-Chang index. If you go back to some of these charts on the Li Ka-Chang index, I shall go back to here, you see the Chinese growth by that measure had dipped down to around 2 or 3% at the worst point of the financial crisis, and then it went to 27.5% growth rate. Well, how did they achieve that? Well, they achieved it by massively ramping up the level of public investment. But that ramping up of public investment entailed a great deal of government borrowing, and a great deal of borrowing also by the private sector as well, which was encouraged to borrow a lot of money. So China's debt to GDP went from 140 to 180% very quickly during that boom, and the problem is it never really stopped growing. So today, China's total debt to GDP is nearly 300%. It's higher in China than it is in the United States, than it is in the Eurozone, or the United Kingdom. And so all of this poses a lot of problems for China. So on the one hand, yes, they're going to reopen their economy from COVID. So that's great news. That could mean stronger growth. On the other hand, the extremely high levels of debt in China have been associated already with a property crisis. By the end of 2016, property investment and real estate related activities, which includes the sale of real estate, banking that relates to real estate, but also the manufacture and purchases of furniture, even other things that have to do with real estate, were consuming nearly 30% of China's GDP. So China became excessively reliant on housing investment. This was not always the case. If you dial the clock back to, say, the late 1990s, housing investment in China in real estate was less than 10% of GDP. So a lot of China's growth over the last few decades has involved huge amounts of residential and some commercial investment as well as public infrastructure. The problem for China now is they're saturated with public infrastructure. They have all the bridges, tunnels, roadways, airports, and train lines that they need. They need to continue to invest a little bit, but not so much because they don't have a growing population. They also have too much housing now. They have more housing than they probably really need. The population's not growing. The rural to urban transition has largely run its course. It may have a little bit further to go, but the demand for housing in China is likely to fall a great deal. So you now have a lot of property developers defaulting on their debt. And you saw this in the last year and a half or so with a collapse of the Chinese corporate bond market. The Chinese corporate bond market, from its highest point in May 2021 to its lowest point late last year, fell by over 40%. Actually close to 50% decline in that index, which naturally means that the yields on corporate bonds are increasing, which makes it harder and harder for China to finance this massive level of private sector debt. And so all of this has been really bad news for the Chinese economy, which is a large part of the reason, in addition to the COVID restrictions, why it was slowing down. But as you can see at the tail end of this chart, there is some good news. The central bank in China has been easing monetary policy. So in the last month or so, there's been this big rebound, which may also have to do with the end of the COVID restrictions as well in the price of these bonds. So it looks like monetary conditions in China are easing somewhat, and that could support demand, perhaps not right away. They could solve a very weak beginning of 2023. But as we move deeper into 2023 and 2024, China's economy might rebound, and we might wind up with some positive news for commodity prices there. As I mentioned, China's economy has been slowing down a lot, but the central bank has been easing policy. And as they've eased policy, the Chinese currency weakened a great deal. It has rebounded a lot in the last month. I think that has a lot to do with the rebound in the Japanese yen, the euro, and the pound versus the U.S. dollar. But I think that China's currency is going to be on a very, very interesting course here. I think that weak economic growth over the next few months, as Chinese people begin to travel abroad, they will, as anybody who travels, essentially sells their domestic currency and buys a foreign currency. So you can pay for the airlines, the hotels, the shopping, meals that you have while traveling abroad. All of that could be somewhat negative for China's currency. On the other hand, if the economy rebounds, the central bank may eventually begin to tighten policy. And as it tightens policy, normally that should be good for the currency. As you can see, the Chinese currency often follows more or less what's happening with China's reserve requirement ratio. The last thing we need to talk about is the rest of the world, which also, from a Chinese perspective, is China's export market, so China's external environment. One thing that's really unique about China, in addition to the fact that they're cutting interest rates while everybody else is tightening policy, is that China does not really have an inflation problem, at least not according to their official national figures. China has around 2% inflation. For once in history, that's actually less than Japan. Japan's inflation is moving up to 3.5%. In Korea, it's 5%. In the U.S., inflation is up around 7% still. We get another number out tomorrow, so it probably fall a little bit, but it's still very, very high. One of the big differences between China and the rest of the world is that China did not do much COVID stimulus. China did go into lockdowns, briefly at the beginning of 2020. Then they reopened everything, for a year and a half. They went back into lockdowns last year. But China spent very, very little money on COVID relief. When you compare to what China spent, about 3% of GDP, is very different than what the U.S. did, which is 25% of GDP. And so when you look at what happened in the U.S. just did this mega stimulus where it took the budget deficit from 5% to 20% of GDP. And then it came back down to around 4% of GDP. And now it's kind of increased again around 6%. So the U.S. has done this massive stimulus, much bigger than what happened in Europe and much bigger than what happened in China. But the problem for the U.S. economy is that stimulus is now over. The same is true in Europe. All the COVID stimulus is done. It's now over. So there's not really a lot of additional boost in demand to go. But in the U.S., the COVID stimulus was so large that I think it was responsible for a lot of the world's supply chain disruptions. Some of the supply chain disruptions got blamed on COVID, shutting down factories or mines and stuff here and there. Yeah, that's true to some extent. But for the most part, the reason why supply chains became disrupted was because the U.S. just spent too much money on COVID relief, and it caused U.S. demand for consumer goods to go off the charts and to outstrip the ability of any economy, including China's, to supply those goods to U.S. consumers. The good news is that shipping costs across the Pacific have come back down. We see U.S. consumer spending has been stagnant now for the last 2 years, basically. So a lot of these supply chain issues are starting to get resolved. But the U.S., I think, have experienced very much a demand shock. So the U.S. saw much higher core inflation than Europe. Europe had a stimulus that was bigger than China's, but not as big as the U.S. And when you look at the core inflation graph on the right-hand side, you can see that the U.S. has much higher core inflation than the euro area. The opposite, however, is true when it comes to overall inflation. Overall inflation is worse in Europe than it is in the U.S., and that has a lot to do with natural gas. Natural gas prices in the U.S. are very, very low. They peaked out at $9 per MMBTU. That's a big contrast to Europe, where the Netherlands price, the title transfer facility price, peaked out at almost $120 per MMBTU. The good news for Europe and for Asia more generally is that we had an exceedingly warm beginning to winter across most of Europe, from France to Russia, including Germany and Poland and Finland and many, many other countries, saw this really, really warm period. And the result of that was that we saw this crash in natural gas prices. So the good news here is that crashing natural gas prices should take a lot of the inflation off of Europe in the next few months. Now, I would warn you, winter is not over. We're only 20% of the way through winter. We still have 80% of the way to go. So the story is not necessarily over yet, but for the moment, it's relatively positive. The fact of lower natural gas prices has been putting downward pressure on fertilizer prices, which is good news also for farmers. I think a lot of farmers felt like they had to make this difficult choice. On the one hand, high prices for corn, soybeans, and wheat would normally have incentivized them to plant more crop. On the other hand, the fact that we had such high fertilizer prices meant that it was often prohibitively expensive for them to plow more crops into the ground. So, farmers now I think will have a somewhat easier choice as fertilizer prices come back down. But when it comes to the U.S., government spending was completely out of control during the COVID period. It spiked from 21 to 35% of GDP. I think that is responsible for a lot of the inflation that we saw. Government spending remains somewhat higher than it was pre-pandemic, and this may still be somewhat inflationary. Now, as you know, the U.S. recently had midterm elections, and we inaugurated the new Congress last week, which, as I'm sure you saw, was a huge mess. It took the Republicans 15 votes to choose a new Speaker of the House. But the U.S. has a lot of experience with divided government, where we sometimes have a president of one party and a Congress of another party. This can happen in two different flavors. There's on this graph, the yellow flavor, which is a Republican president like Reagan, Bush, or Trump governing with a Democratic Congress, or you can have the purple flavor, which is a Democratic president like Clinton, Obama, or now Joe Biden, governing with a Republican Congress. And these two combinations produce essentially opposite outcomes. When you have a Republican president governing with a Democratic Congress, like we had under Trump and under Bush and Reagan, the result has been explosive growth in government deficits. Because under that combination, everybody gets everything they want. The Republican president will get tax cuts, and the Democratic Congress will demand spending increases. And so you wind up with much, much bigger budget deficits. Under the current situation, which I think we're about to see again in Washington, we're already starting to see it, nobody gets anything they want. So under Obama, when he governed with a Republican House of Representatives, and under Clinton when he faced a Republican Congress, previous tax cuts were allowed to expire, which allowed tax rates to drift back higher towards higher levels, and there were severe restrictions on growth in government spending. So government budget deficits came way, way down under those two situations. The Republicans in Congress have made it very difficult for the U.S. to entertain any sort of new spending legislation. They're looking to dramatically cut government spending. And so this could help to shrink the deficit over the next few years, which could potentially be good for the bond market, but is also somewhat disinflationary. Smaller deficits mean less fiscal stimulus, which could mean somewhat less growth. When it comes to interest rate markets have often liked smaller deficits. The stock market often responded very, very positively to having a Democratic president and a Republican Congress. There's no guarantee that will be the case this time. But as I mentioned earlier, the Federal Reserve this year did more interest rate increases than it has in any other year since 1981. And the market thinks the Fed is not done yet. The market is pricing that the Fed hikes rates again in early February and again one last time in early March. So all of this, I think, is very worrisome for the U.S. economy. We talked about China's huge buildup of debt, which has happened since 2009. The U.S. debt has been building up for many decades. But if you look back at 1981, the last time the Federal Reserve hiked rates this much or more, the U.S. debt levels were less than half of what they are today. So the problem is that when you have higher levels of debt and you raise interest rates, the economy becomes very sensitive to those interest rate increases because the level of leverage in the economy is much, much higher. So I think the U.S. economy is going to respond very negatively to higher interest rates. I think the same is true here in Europe. And the markets essentially agree with me. The markets say, okay, well, the Federal Reserve is going to hike rates 2 more times, and then by the end of this year and next year, they're going to have to start slashing interest rates. So the market is basically pricing that the Federal Reserve puts the U.S. economy into a recession. There's one thing the market prices that I do think is very strange. The market seems to price that inflation is going to end very, very quickly. The market prices that inflation this year is going to come right back down to 2% in the U.S. I find that very, very hard to believe. But the market, for its part, has an extremely inverted yield curve. So short-term interest rates in the U.S. are much, much higher than long-term interest rates. And typically an inverted yield curve implies a coming economic recession. You can see that there is a positive correlation between yield curve shape and what happens to the U.S. economy, especially 4, 5, 6, 7, 8 quarters in advance. So the inverted yield curve does not mean that the U.S. economy is going to have a recession in the next few months. In fact, I don't think it's likely at all that the U.S. economy is going to have a recession in the first half of 2023. So I think inflation will be sticky. The economy will continue to grow for maybe another 6 months, possibly another year. But it looks to me very likely that in 2024, the U.S. economy is going to experience a recession. And that's going to be a very, very big deal because 2024 is also an election year. And it could make it easier for the Republicans to come back and win the White House. The U.S. economy, as I mentioned, often follows what happens to the yield curve. You can see around the year 2000, again in 2007, and again in 2018 and 19, we got 2 inverted yield curves, and the U.S. economy slowed down or experienced recessions in the aftermath of those periods. Now, not only do we have an inverted yield curve, we have the most inverted yield curve since the early 1980s. So I think that we are going to be looking at a recession in the U.S. Sometime in a not so distant future. And I think that same can be true in Europe. It may take a little bit longer in Europe because in Europe the yield curve is not as inverted, but the ECB is going to continue to hike rates, I think, at a fairly fast pace over the next few months, even faster than what the Fed is doing. I think another reason to be concerned about where things are going is the level of valuation in the stock market. In the past, Republican Congresses governing with Democratic presidents were good for stocks, but that was also in a context of much, much lower levels of valuation. Now valuation levels are extremely high for the stock market. The stock market, as you can see here, tends to vary inversely with the level of interest rates. So the problem with interest rates now is that they've been coming down for 40 years. Now they're starting an uptrend. That can be very, very bad for the stock market, which still has very, very high levels of valuation, especially if inflation proves to be more persistent than the market believes is likely to be the case. So anyway, I've been talking for a while. I think I'll take a little break here, open things up for questions if there are any questions. If there's not enough questions, I have a few more slides I'll show at the end. But I know I've been talking for a while, so I think it would be kind of a nice time to take a break and see if there's any questions out there.
Thank you, Erik. Yeah, sure. I actually got a couple of questions, so I'm going to read it out now. What other markets do you keep an eye on when trading commodities?
Okay, so I think one of them to keep an eye on is going to be gold. I didn't bring this up too much. I should have put in more gold slides. Yeah, but let's go back to this chart here. So gold prices have not done well during the last 2 years. I think a large part of the reason why gold has struggled is because the Federal Reserve has been raising interest rates so much. So gold has a very strong negative correlation to anticipated changes in future Fed funds rates. And so, as the market anticipated the Fed going from 0% rates up towards maybe 5% rates, that was really, really bad for gold. But just in the last few months, we've started to see this new shape in the forward curve. We've seen this big rally at the back end of the forward curve. And so gold prices have started to move. Gold has moved up from 1650 to around 1850 an ounce. I think that what's going to happen is this. I think what's going to happen is that the Fed is going to put the economy into a recession, and that in 2024, they're not going to cut back only to 3%, like the market price. I think they're going to go to 2% or 1%, maybe even 0.5%, maybe even 0. And that when that happens, the price of gold is going to rocket, and it could go way past $2,000 an ounce. So I think gold is a really, really interesting one to watch here. Another market I haven't talked about extensively is copper. Copper is also a very interesting market as well. It relies very heavily on what's happening in China. Copper, I think, is going to be in really strong cross currents. So copper typically doesn't like it when the U.S. equity market falls. The U.S. equity market's still, to my mind, very overvalued. Could fall a lot further. China may have relatively rough beginning for this year. So I think copper prices might fall further in the short term. So I'm somewhat bearish on copper, but very, very bullish on gold. Somewhere in between those two is silver. Silver is more closely related to gold than it is to copper. But silver, I think, also could be an interesting one to watch. Silver has a big role to play in the energy transition. Among other things, it's used in solar panels. So I think there's a lot of very interesting things to watch for and to say about silver as well. In addition to that, we've already talked about the agricultural goods and oil. I think that they're in a very complex situation. On the one hand, China's reopening could be very positive for them eventually, but eventually may mean next year and not this year. What's happening in China's external environment and property sector may not be so positive for those kinds of goods. So the reopening is probably a good story, but the property sector and the Fed tightening may not be so good for those other commodities.
Thank you, Erik. Another question is, are there still commodity currencies?
Yes, and so there are certain currencies that still do follow commodities quite closely. I think the two that follow commodities the most closely are the Australian dollar and the Canadian dollar. Those two currencies didn't diverge too much from commodity prices over the last few years. But the COVID period is still very disruptive for these kinds of relationships. It used to be that the Brazilian real and the Russian ruble also followed commodity prices very closely, but there was a huge, huge divergence between those currencies and commodity prices during the pandemic. Those two currencies performed generally pretty badly, even as commodity prices had this huge rebound at the end of 2020 and early 2021. That may have been because of the tremendous spread of COVID in both Brazil and Russia, which really dampened economic activity. And of course, now, the Russian currency is sort of like the Hotel California. You can check out, but your money can never leave. So it's sort of a one-way currency that can't really be fully traded. In a sense that they won't really let you bring the currency back out of the country. So I think the two remaining really strong commodity currencies are the Australian and Canadian dollars. To a lesser extent, there are others. There's the Brazilian real, the Colombian peso, the Chilean peso, and the South African rand would be the other one.
Perfect, thanks. What will likely determine how commodities prices track?
So I think the single biggest thing is what happens to growth in China. So China has really strong influence on industrial metals and on oil, and through the oil market has a really strong influence on what's happening in agricultural markets. And the good news is that those effects happen with a long lag. So if China goes through a slow patch today, that could mean downward pressure on commodity prices, maybe as much as a year in the future. Likewise, as China begins to rebound, which I think is likely for the second part of this year, maybe even the second quarter already, that could be very positive for commodities, but it could be positive for them further down the road, maybe in 2024. So I think that China is the single biggest influence, but there are commodities that are influenced by other things. Agricultural goods, of course, is influenced by the weather. Right now we have a strong La Nina pattern happening in the Pacific. Agricultural goods are also very disrupted by what's happening between Russia and Ukraine. And then certain commodities, especially gold, are very strongly related to interest rates. So I think that those are the main things that influence them, depending on the commodity. It can be China, weather, geopolitical conflict, or interest rates.
Thank you. Is the commodities market better for investment as compared to the stock market?
So I think it depends which commodity. If I had to choose between stocks and gold, I would prefer to hold gold than to hold U.S. stocks. Now, the U.S. stock market is not the only stock market in the world, as we know. I think it just happens to be the overvalued stock market, where the valuation levels are the highest. I think if you look at stocks in China, Korea, Japan, Western Europe, the valuation levels are not so bad. European stocks, for example, have been outperforming U.S. stocks quite a lot in the last several months. But when I look at the U.S. stock market, I'm very worried that certain companies, especially Tesla, Meta, Amazon, Apple, and Google, are still very dramatically overvalued. And the problem is that those 5 companies are still a big share of the U.S. equity market. They're a huge portion of the NASDAQ and a significant portion of the S&P 500. So if I were to invest in the U.S. stock market, I would be more inclined to invest, say, in the Russell 2000, which is an index of small cap stocks, on which there's also a very liquid futures contract, than I would be to be long the NASDAQ or the S&P. If I had to choose between the S&P and gold, I think gold is perhaps a much better investment. I think gold prices could go much higher, whereas I think the U.S. stock market is still potentially overvalued.
Erik, another question is, can we expect the commodities super cycle due to the dollar strength?
Yes, this is a tough one. So I think what's tough about it is that there's no clear definition of what a commodity super cycle is. So the way I understand it, and the way I think is the best definition of commodity super cycle, is that the commodities are always in a super cycle. And a super cycle takes place over roughly a 3-decade period. And so basically there's an up decade in which commodity prices soar. And so that was the case in the 1940s, in the 1970s, and again in the first decade of this century, so between 2000 and 2010 or 2011. And during the bull market phase of the super cycle, commodity prices often rise 300, 400, 500%, and it's a decade-long trend. Then there's a second phase of the super cycle, which is the bear market phase. And the bear market phase usually happens right after the bull market. So during the 1980s, commodity prices crashed. During the 2010s, commodity prices crashed, especially from 2011 to 2016, but some of them didn't hit bottom until 2020. And then there is the third phase, and the third phase of the super cycle is the phase I think we're in now, which is the sort of sideways consolidation phase. So, for example, commodity prices traded sideways in the 1960s. They went sideways in the 1990s. And so what's happened so far this decade is we had this huge drop in 2020 at the very beginning of the decade because of the lockdowns. Then we had this mega rebound where commodity prices went up 100%. And so during this time, the news media started calling this a super cycle. But to my mind, a super cycle is distinct from a short-term bull market. I think we had a short-term bull market because central banks cut interest rates to zero and governments spent massive amounts of money on COVID relief, which caused this huge boom in demand. But what's happening now is the opposite. So now governments are slashing spending, central banks are raising interest rates, and they're reversing quantitative easing. So many commodity prices have been coming back down. We've seen huge declines in prices of agricultural goods, huge declines in the price of copper, huge declines in oil prices in the last few months. And so I think that this process might not be over. And so, I think that what's sort of stupid about the way the news media uses the word super cycle is they use super cycle as a synonym for bull market. But that's dumb because in order to have a cycle, you have to have an up as well as a down. And so now we're kind of in a down, we're in a bear market, but I think we are in phase 3 of the super cycle, which is the consolidation phase. And I suspect that this is going to happen for the rest of the decade. And to get to the next thing that the news media is going to call a super cycle, by which they mean a bull market, we'll have to wait until the 2030s. In the 2030s, I think we'll have a big bull market. But in the meantime, I think commodities are going to go sideways. They're going to be very volatile. So the right strategy to follow for commodities in a consolidating market is a mean reversion strategy. You try to buy them low and sell them high. Where the right strategy in a bull market like we had in the 70s or in the period from 2000 to 2010 is you just stay long and you just ride the trend. And the right strategy for the bear market is you just stay short and you ride the trend. But now I think we're in a cyclical environment. I think the Chinese growth story, which drove commodities higher, is dead. I think China, they will have a lot of volatility. They're going to have this dip in growth as they reopen because of the mega spread of COVID. Then they're going to have a huge rebound. So we're going to likely have a bear market in commodities followed by a bull market. But overall, we're in a part of the super cycle where commodities go sideways, I think, for the rest of the 2020s, but they're going to go sideways in a huge range, and you can range trade it.
Thank you so much, Erik. I guess we're running out of the time. Nick, did you want to ask some question?
Only on the back of that last bit, Erik, this short-term boom bust we're seeing, do you think that's also driven by the ETF market, where the exaggerated volumes going into the futures market now from the ETF side is just creating these massive spikes and dips?
It may be having an influence. Yeah, I mean, I think that that investor flows are one of the many things that influence commodity prices, and when the Federal Reserve created $4.9 trillion of assets in QE, and other central banks like the European Central Bank actually did an even bigger QE than the Fed did, it just created huge amounts of assets. And so some of those assets found their ways into ETFs, and then that influenced commodity prices and lots of other prices for equities and all sorts of other things. And now the central banks are raising interest rates and they're shrinking their balance sheets. They're essentially doing a reverse quantitative easing. And the Federal Reserve is, in addition to raising rates, they're also pulling $120 billion per month. $95 billion per month out of the bond market. The European Central Bank is getting ready to pull 15 or 20 billion euros out of their bond market every month. And so ultimately, this will suck money out of all sorts of investments, including ETFs, and that could contribute to some, at the margin, some selling pressure in commodities. I'm not sure it will necessarily be the main driver, but along with a whole bunch of other things, it's going to be a contributing factor.
Thanks. I'll let you finalize.
Right. Yeah. So I think that, I think the message is that we're going to be on a real roller coaster over the next few years. So China in the next few months, I think, is going to suffer a lot as COVID spreads. That I think they're going to have a mega rebound in domestic consumption and international travel. This will ricochet through commodity prices. I think probably first a bear market and then a bull market as we go into 2024. And the other part of it is that, I think the U.S. economy is kind of the opposite. I think the U.S. and Europe continue to grow in the first half of this year, but then the cumulative effect of all of this interest rate tightening is going to hit in the second half of 2023 and especially in 2024. And I think the U.S. economy is going to be in a big, big recession. And the Federal Reserve is going to slash interest rates, maybe down to 2%, 1%, maybe even to 0. And that's going to put gold potentially on a huge, huge upward rally. So I think it's going to be an incredibly wild time. You're going to see exceptional volatility in markets. I think you're going to see explosive rise in volatility in equity markets and commodities. So it's going to be, I think, a very, very interesting time to trade and to gain exposure to these different markets.
Thank you, Erik. We're running out of time. So thank you so much for your time today. Thanks to CME Group for helping us organizing these webinars. And thanks to all attendees today. I hope you enjoyed this webinar and see you next time.
Thanks, Erik.
Thank you.